Ladies and gentlemen of the crypto space, we're live on a Monday, July 3rd at 11:37 a.m. So, obviously, a couple of good tweets over the weekend, and we have a nice holiday tomorrow, but we have a nice couple of topics to talk about, as well as what just happened 3 days ago with the close of the 6-month candle. And that's very nice from what I see from a structural perspective. So we're going to pull up and start this topic off uh, describing the three banking innovations. As you see on the screen, are these banking innovations in the room with us? Okay, behind there is Android Studio because let me see if I can move things around. Oh, let's do this. I got a mess. Okay. Okay, this is going to be a mess. Let's do what I can. Okay, so deterministic monetary policy changes everything, and that's Bitcoin. It's as simple as that. And is it showing the right screen? Yes. Okay. And that's the original, and that's proof of stake versus proof of work conversation, and how resistant these monetary policies are to actor intervention, which obviously includes state actor intervention and actors of very large power. So deterministic monetary policy is significant. So these three things are important because they play into the most important topic of what's coming with central bank policy, particularly what the IMF has in mind for central banks. Um, Immutable contracted CDPs, which is basically a collateralized debt position, which is basically the Eurodollar system. The innovation here is deterministic liquidation, permissionless management, protecting infrastructure from debtors. So in crypto, what we've seen is you're liquidated, no questions asked. It's not going to happen. There's no courts that could get involved. The contract is going to execute. And this is something that is, in theory, part of what the central planners want for their system as well. So this implementation protects the system from anyone who took excessive risk. They're going to get liquidated no matter what. And all effort uh, is extended to protect the infrastructure, and that changes everything. That's what's significant. It's what changes compared to the status quo, and that is a significant deviation from the status quo. Currently, if debtors are liquidated or they're margin called or they default on debt that they owe, the bank takes a hit, they take a loss, they write it off. They're taking on risk, but in this type of implementation, that risk is intent to be passed entirely on to the debtor. Protecting the infrastructure because the infrastructure is there for everyone. And AMMs. So this is an order, by the way, in my opinion. So AMMs disintermediate banking. So the purpose of a bank is to intermediate settlement, or frankly, just to facilitate settlement, and they do that by intermediating transactions. So they have a ledger, and if I have an account and someone else has an account, and you want to send capital, you're just transferring money from the ledger entries of two people's accounts in their ledger. So that's how they're able to intermediate that transaction relatively easily. So it gets more complicated with regard to correspondence banking and with regard to international banking, which historically was just large correspondence chains. Probably central banks are in the mix, or especially with regard to SWIFT and especially with regard to FedNow, whatever the hell they're going to do in the interim until they have some sort of larger scale ledger in place. And that's what the IMF is always talking about, where you have this global ledger and maybe the central banks just have accounts on this global ledger, and now you're able to move liabilities from anywhere to anywhere, and it's just a centralized ledger for the entire planet. So what we have here is what a lot of folks skim over or historically skimmed over with regard to the significance of crypto markets is actual innovation, financial innovation, banking innovation, real things that are significant compared to the way things are done from a status quo perspective in the banking industry. Determinism. immutable, permissionless, that does the exact same shit that a bank does. Okay? So we said a bank handles the settlement of transactions because they have the ledger and you're able to move liabilities from one to another. Everything else a bank does is just business, meaning they're doing things for their own bottom line, their own profit margin, their own employees and income and stock profile and investors. Central planners don't give a fuck about a bank's profitability. What they care about is the capacity of a bank to fulfill their integral responsibilities to a functional financial system. So, first off, regional banks are literally useless from a central bank perspective. What's pertinent is maintaining the status quo capacity for the GSIBs or the central bank itself to provide those lending facilities. That's all banks do. Banks settle transactions and provide credit and offer access to products and services which are mostly for the bank's bottom line, or an intermediary. They're further intermediating access to central bank and U.S. Treasury opportunity with regard to debt investment. Pick your Treasury instrument, and then bank just intermediates that transaction. So they're expendable in all regards, from a societal structural stability standpoint. So the GSIBs, here's the thing: the big ones, the big banks, they're so powerful that I don't think you can really get rid of them. And at some point, they'll just be synonymous with central banks. Maybe they'll try and trim them down. It's not like they're intentionally trying. They can't intentionally try and trim them down, but they can just keep raising rates and keep putting financial pressure on them. And maybe you'll get like a Bank of America to fold, and you only have Chase and other very core centralized GSIBs that remain. The fewer the banks, the easier it is for the central banks to maintain or manage liquidity pressures in the system. For the central banks to manage liquidity in the system, they need to have a sense of all the transactions in the system, so they know how much pressure the central bank can apply to credit creation, currency printing, which increases currency supply, and also where it goes by rules. And the more concentrated those capital flows, the more rules can be applied, the more incentives can be applied, and the more incentives for credit extension and currency printing can be offered, and the contrary as well. How much restraint can the central bank place on these monetary pressures of credit extension and currency printing? And this is how they control, in a good way, inflation, consumer price inflationary pressures, the prices of goods and services in the real economy. And that's all good. That's meaningful. It's important to have stable inflation rates, and you're not going to have that if the currency doesn't have enough supply. You're not going to have that if a currency has too much supply. So this is very contrary to common Bitcoin narrative, where a restricted supply, that's the significance of that narrative is only meaningful in the context of an ever expanding fiat currency supply. But you can't have a restricted currency. If you restrict the currency, it's just going to increase in value relative to goods and services, and that does the same amount of damage to an economy as excessive currency. Nobody's going to spend it. There goes credit extension. There goes monetary velocity. You don't have a functional economy if no one is spending the units. So I think we're heading into a world that's both good and bad. We need control over the global currency supply. It needs to be elastic. You can't have too much. You can't have too little. It needs to be managed. But obviously, we also have um, our privacy concerns, and so it's complicated in that regard. But we know for certain they're heading down this road of wanting to shrink the amount of banks. Why? Because they're raising interest rates, and obviously they say that's for curbing consumer price inflation. Yes, and that's obviously a very front-facing narrative that's presented because it does do that. But we also know that behind the scenes it's very easily the case that conversation is like, oh yeah, we're going to do that, but that's also going to put significant pressure on bank balance sheets that bought a shitload of our debt, and therefore we're able to push them into difficult balance sheet states and trim off the smaller banks. And the reason why they want to trim off as many banks as possible is because the more banks, the more ledgers that exist, it is harder to have a sense of where the hell the capital is flowing. More information, the more complicated the analysis is. The more concentrated things are, the easier it is to see what the hell's going on with the capital in the system, and the easier it is to subjectively manage policy around it. But look, one of the biggest innovations of crypto is deterministic monetary policy, where it's going to do what it is expected to do under particular circumstances. So we're still in the realm of subjective human monetary policy, which is silly. And I don't think that's where things are going to land with regard to the central planners and IMF. They're probably going to do, it's going to be some sort of hybrid system. They're going to want to also minimize human intervention and human work. They want the system to be more predictable. A more predictable system is going to be more sustainable, but it's kind of probably going to be like a giant multi-sig where they're able to make small adjustments here and there. But what's powerful about what has been presented thus far in crypto is deterministic and immutable. It cannot be changed, and therefore it's neutral. And that's fair. It is less fair when modifications can be made. So probably the final thought, and then I'll get the questions, is how does crypto play into what the IMF wants and what frankly central banks want, and probably what's good for normies and the overall population of the planet with regard to, a stable system for the vast majority to use. So they're going to throw incentives everywhere. Stability, it's faster, it works, it's accepted everywhere. You can bring capital across the planet from one country to another. Everything is seamless, everything is automated. You want to sell a property, it takes 2 seconds. You want to sell a car, it takes 2 seconds. There's no more title companies, there's no more underwriting. That's all automated, that's all integrated into smart contracts. So they're going to be able to sell these central bank currencies or whatever ledger system they title it. They're going to sell it really easy to the normies because it's just going to be incentivized all over the place. But the Wachowski brothers taught us very significant things. And most importantly, they taught us people have to accept it, if only at a subconscious level. So you need the opt-out. You need the Zion. I mean, they nailed the psychology of humanity to such a T. So you need the opt-out. And historically, the only opt-out was gold, but that wasn't a structured financial system. It's literally just, it has no place in modern financials as a currency. It has place as collateral, obviously, it has a place as a scarce asset, and that's significant, but it has no place as a currency. But so you need the opt-out mechanic to be the contrast to what everyone is opting into. That way everyone has that subconscious offer made to them. So that's in many regards what I think is playing out with regard to crypto, because it is functional. You can do settlement. You can have monetary policies. Therefore, you can have state actors, sovereign countries using these types of systems that are not part of this global centralized implementation. You have a capacity to extend credit. You have a capacity to protect the system. So crypto is just like the current system, but it's actually more resilient. So it's kind of like if the current system is 1.0, crypto is 1.5, and then the IMF grand scheme would be a 2.0. And the 2.0 will be opt-in, but the people that are like, all right, I'm not ready for that, they got their 1.5 system that is much better and much more resilient as compared to 1.0. So that's big, and that means a lot of things, in my opinion, with regard to what is going to play out with regard to incentives, with regard to support. I think we're at the point where crypto is needed, because you think the central planners are like, yeah, let's let African countries keep propping up these shitty fiat regimes, and Africa, the nations keep cycling these horrible fiat systems that keep failing, or do we support these crypto solutions that and encourage these nations to adopt these more resilient, more anti-fragile systems that would better serve them, and what they want is a stable financial system, but it also plays into what they want to do from a central planning perspective. So that's quite interesting. Quite interesting. Anything else that I mentioned in the last couple of tweets that you guys find interesting or you want me to talk about? Please make mention. Yeah, I was talking about this notion. The role of central banks has always been now front and center to manage the liquidity in the system. That's always been the case. CPI. And it's not about CPI. CPI is a knock-on effect of managing the liquidity in the system. Everything is about it's always about managing the quantity of currency units that are available in different parts of the economy. But they have no control. They have absolutely no control over managing CPI that's a manifestation of a fiscal policy. And that's exactly what Lynn Alden and Luke Groman are talking about most recently with regard to fiscal dominance. Has nothing to do with credit extension at the banks. The high interest rates are literally producing or manifesting little to no balance sheet capacity by banks to extend credit. So this is the last thing we have is consumer price inflation because of credit extension. This is all fiscal policy related. Yeah, and by the way, they printed $1 trillion. I mean, is anyone talking about that? Of course, a couple of people are talking about it. But in 1 month since the debt ceiling is lifted, they issued basically $1 trillion worth of bonds, and their national interest went up $1 trillion, which is basically an increase in currency supply by $1 trillion. That takes time. So at first, it's deflationary because the $1 trillion is coming out of circulating supply, but the TGA gets refilled, and the TGA gets spent into the real economy, or maybe it goes into the financial economy. So it's complicated how those new currency units flow through the system. But now there's also $1 trillion worth of collateral, additional newly issued collateral in the system, which are used internationally to print dollars. So that's how national debt has short-term effects and long-term effects. Short-term, a quick snap of deflation depending on how fast the TGA spends it into the financial or the real economy. Where it goes in the economy has different effects. And we know what the collateral is going to do with interest rates like this and the DXY where it's at. Interest rates are going to place a very nice discount on the printing of dollar liabilities using U.S. sovereign treasuries as collateral. Tapsy's in the house. Dave, Alex, good morning, a pleasure. We're live on a Monday. Asarco, hey, time to peer through the madness. Yeah, do the best we can here. Tapsy, 6-month candle observer. Let's do it. Let's do it. Let's move this here. And let's go back to the chart. This chart is absolutely stunning. You know, a lot of folks, this is Forex, so obviously a lot of folks find this or have a very trading perspective on this chart, and a lot of folks look into Japan and Europe. The conditions in Europe and Japan are primarily what manifests its chart. And so that's meaningful from a geopolitical perspective. So the question in my mind is, does geopolitics, I mean, it's kind of like what's the causality? Does the geopolitics cause this chart to move in a direction, or does this chart cause geopolitics? But in any regard, I would argue that this chart is depictive of political choices that have been made. So I would say this chart is a lagging indicator of political choices. Basically, the Japanese and European level with regard to the state of their currency or the state of their financials. And this chart screams a couple of different things, and we've talked about this. So the close was consistent with what I was expecting. It was a close below 103. 103 is like a magic number on this chart. I mean, look at it. Take a peek at this. Look at this perspective. Let's get a marker out. Rectangle. And let's do this. So look at that. Look at that 103. What do you see there? What do you guys see? Oh, not that. You got to black out the 103. What do you see there? Every time it broke above 103, it was up there. It was like a ship or a bird going up through the clouds and falling back down. Like it just, there's no support above 103, and in so many regards, that's a political reality. You can't have the dollar that strong with the global order of things actually functioning. So what do you see here? I mean, obviously you have your lower highs, but you also have a significant decrease in duration above the 103. I mean, back here in the 60s, that was, a decade. And then in the 70s, it was a couple of years, about 6 years. And then in 2000, it was 2 years. And then in 2022, it was like 5 minutes. It was less than 6 months. That's a shooting star. So this chart basically screams geopolitical organization coordination. That it is a managed currency. Every central bank organizes with one another, and there is a regime. There's a global order of things, and there's coordination such that the currencies of various allies and various sovereign nations actually continue to work. This chart screams very interesting things. Look at the bottom. It's January 08. We have been a bull market for the dollar against the euro and the yen for 15 years. That's crazy. It's been a straight up bull market for 15 years. And we finally, after all these years, see a rounding top. I mean, over here, this was just up and then down in a 2-year period in 2000. But this is a rounding top. This is a 6-year rounding top. Let me get the marker and I'll show you what I'm seeing. I mean, look. Ooh, that's a rounding top. Well, that's obviously a peak. That's obviously a peak. But this is a 6-year rounding top where you had a failed breakout here and obviously depreciation, and nothing is perfect to a drawing. But that's clearly a couple of interactions with this 103, this magical 103 line. 2 failed breakout attempts in 16 and 17, the insanity in 2020, and then 22 was just a complete shooting star above resistance and failed. It failed back in the 70s, it failed in the 80s, it failed in the 2000s, it failed in 16 and 17, it failed in 2020, and a breakout attempt above 103 has failed in 2022 and 2023. It closed below. So here, this close alone, look at the green line. This close on last halves, H1 2023 closed below the high put in 2020, which invalidates this entire move. Completely invalidated because the candle closed. And not only does it completely, why does it completely invalidate it? Because you had a bearish candle after the breakout, but then you have the confirmation of the bearish candle because the bearish candle right here closed below the open of the previous candle. And to top it all off, it closed below the high set in 2020, the 103 mark. What a remarkable chart. What this chart screams is increasing international liquidity conditions of the likes that we haven't seen since 2008. Well, frankly, the starting of liquidity conditions that markets haven't seen since about 2002. So what was international liquidity conditions like in 2002? And what effect did it have on the markets? And that is the question folks should be asking themselves because that's what this chart says. And to top it all off, we have confluence. So if we go back to 2002 right here, give or take, 2002, 2003, we have confluence. So when moves started moving down in 2002, 2003, that is confluence suggesting increasing liquidity conditions internationally because this allows the printing of dollar liabilities. You can't print dollar liabilities from U.S. Treasuries unless the volatility is low. Otherwise, people are trigger shy and they don't pull the trigger. But that's a very similar setup here with regard to a rounding top, or at least a confluence with a very notable ceiling and directionality reversal indication. Okay, if it stays unzoomed out. So this looks like it's rolling over or prepared to roll over. The dollar looks like it's prepared to roll over, but these things don't roll over in 5-minute intervals. This thing's going to roll over for years. It took 1, 2, 3, 4, 5, 6, 7 years. 7 years after the top in July of 2001 for the dollar to bottom. 7 years. All right, so in this regard, maybe we do have the 40s written all over us, especially as Lynn Alden talks about fiscal dominance. Like the 40s type of inflationary environment, what's causing the inflation, but like a 20s precursor to some sort of financial insanity. And then we have increasing liquidity screaming in this data, and that'll run up the markets to insane heights, and then you have some sort of crisis in liquidity, and there goes the markets. But you're only going to get that big crash, like a 29 crash, after a significant run-up. But these conditions look primed like the 20s. Liquidity is just looks flush over the next 2-3 years heading into 2025. We'll see what happens because obviously you have the backdrop of commercial real estate and student loan repayments, and that's going to suck liquidity out of the system. But that may be just the real economy. That's the most important thing to remember. You got the real economy and the financial economy. So when you're talking about commercial, but there's a knock-on effect. So obviously you have the instability and volatility in the real economy. Commercial real estate implodes, 5, 10, 15, 20 banks implode. You have the potential for liquidity to dry up as there's potential capital destruction. But look what the BTFP produced by the FDIC, their bank bailout program, more or less. That prevents the destruction of capital, which increases liquidity in the system. Because if you're preventing liquidity from being destroyed, you're adding liquidity to the system as if it was destroyed and you're just reintroducing it again. So let's see what happens in that regard. My expectation is they paper over everything and maintain everything as stable from a financial economy perspective, and they keep rates high to constrain credit. Lynn Alden's recent piece really nailed it. Like they're trying to handle consumer price inflation. The only way they can is with constraining credit extension, which constrains currency production in the real economy. So if you don't have credit, you're not going to have currency expansion. You're not going to have more currency units chasing the quantity of goods available. But for the real economy to continue churning, for fiscal to be able to be serviced by, how is Treasury going to service the fiscal policy of Congress? Where are they going to where the hell are they going to get this kind of tax revenue? It's just the only way is to juice the financial economy, debt issuance, which is basically currency expansion. And we already have financial economy currency expansion by $1 trillion in the last month. Let's see what happens from a central banking perspective at some point when the marginal buyer internationally dries up. The rates will potentially go too high, and that's where the Fed's going to have to step in. And they'll have to call it a new 3-letter acronym instead of financial quantitative easing. That's just too politically hot. But the Fed will have to finance fiscal policy vis-a-vis buying Treasury issuance to prevent rates from getting too high, which throws the entire debt servicing loop out of whack. And then obviously it's the job of Congress to make sure the capital raised by the TGA that refills the TGA account is used to create productivity. Productivity would increase tax receipts, and they want tax receipts to be greater than, was basically delta GDP is greater than the growth in debt servicing obligations. And then you have a sustainable equation. But that's clearly not been the equation. How much growth in GDP have we had? Real productivity, or inflation adjusted. Hope that helps, guys. Ding ding. Good morning, Paul. Good morning, Sir Joe. Enough time to waste. Koji, genuinely curious if Curve's code is immutable. How was protocol able to implement Curve USD? New contracts. Curve USD is a completely new set of contracts. Koji, I'm trying to get a better understanding of the definition of immutability. Immutability is the deployment of a contract that cannot be changed. Now, bear in mind, those contracts can be coded to be extendable and to have configurations. But what's pertinent is outside of configurations and extendability, the actual code cannot be changed. So it's not like a proxy contract where you could literally change the entire implementation of a contract that everyone's consuming. For instance, you go to a user interface and you're interacting with a contract. With a proxy contract implementation, you could go to that user interface and you can actually change the entire contract that user interface is interacting with without modifying the user interface. But whereas with immutable contracts, you cannot point to any contract you want. You only have one contract, but you can only change its properties as originally designed. So you cannot mutate the contract outside the scope of what was originally intended by the contract when it was published. That's more or less what immutability is. I know that's a lot. And obviously, I'm saying that from a software engineering perspective and my experience. But listen to that 10 times over, and please feel welcome to ask questions in that regard. I think that's very important that we understand these critical concepts: determinism, immutability, and permissionlessness. And this is really why I think the central planners see what has been built here in the last couple of years is a very significant opt-out. And they need the opt-out because they're going to build the world's biggest opt-in. And the only way to get everyone or the majority to opt in is you have to offer the opt-out. And the Wachowski brothers taught us that. It's fucking crazy. It really is. They really nailed it. There's got to be some philosopher in history that the Wachowski brothers borrowed that concept from when they created their fiction. So if anyone's listening, do us a favor and find that. Where did the Wachowski brothers get that? That if only at a subconscious level, that's how you get everyone to opt into something. And but you have to offer that opt out. That makes all the difference. That means systems of control. And it's a video game, and just remember, I mean, literally, the current system is a video game, and you're using dollars as points. What's the difference? It's a point system. So this game is scored in dollars. We've been saying that for a long time. Project Marianne, that's right, that's big stuff. Quite interesting. I think I missed the part of what the IMF is planning. Gonna have to rewind on that bad boy. George Gammon nailed it the other day, so 2-3 days ago. Just go on YouTube, hit up George Gammon's videos and what the IMF has in store. And it's coming in one way, shape, or form. Dan's in the house. You're going to like this one. Start from the beginning when you get some time. But we talk about, what you want to hear, where I see things heading, how crypto fits into the grand scheme of things. And once again, we find a matrix moment. Crypto Jake's in the house. One curious view of Sarko. It's universal law, the principle of polarity. I encourage reading the Kybalion. Is it really? That's very interesting. Yeah, I would also encourage anyone to read this significant source of this historic philosophical concept. That's really what governs how central planners manage a population, how they encourage behaviors, how they control behaviors, how do you get people to opt into behaviors. The whole system, it's all about incentives. It's all about subliminal incentives where you don't even know where you're making a choice. You don't even know you're offered a choice. You might not even be offered a choice. And that's quite fascinating psychology. So I appreciate that. Good stuff. Hermetic philosophy. Yeah. Look into that, folks. The better you understand psychology, better you understand philosophy of how humans make choices and incentive systems, the better you'll navigate crypto markets and financial markets, because that's all these systems are. Financials are literally a means of organizing labor, incentivizing labor, and rationing resources. That's what a financial system is. Incentivize labor and ration resources. Digest that shit, and that shit'll make you a little disheartened and blow your mind simultaneously. Let's wrap it up for today. I appreciate all of you. 30 people remaining in the stream towards the end. 16 likes. Hit that thumbs up button. Tell everybody to subscribe. Monday, July 3rd, 12:15 p.m. You know the deal. In the description, Captain Rational's Discord, where it is the most rational community in the entire crypto space. I appreciate everyone that has stuck around the entire bear market. And guess what, folks? Need to remain in markets. There is no exiting markets and re-entering markets. You need to be in markets, navigating markets, and the best place to navigate markets is in our forever rational Discord, because there is no FOMO in this Discord. There's no to the moon. There's only logic and reason and rationality and capital management and actually doing good things, smart things for you, yourself, and your family. So appreciate all of you. Wish you all a good one. I will catch you on Wednesday. See you then. Peace.